Hi everybody, my name is Yuri and this is the next CLIQ webinar, Money Management as an important component of successful trading. And outcomes of this webinar are the next one: money management and diversification, similarities and differences, most popular methods to manage your trading money, and the last one is the money management of successful traders. If you have any questions during this webinar, you can ask them in section comments and our team will answer you. Also, under this webinar, you can find the link to our website where you can find information about our company, services and products. So let's get it started. I think, hope and believe that you really understand what is the money management, and you probably understand that to be successful in trading or in life, you definitely have to manage your money smartly. So there's why without that, for the long term, there's no chance that you're going to be successful if you don't manage your money rightly. So that is like the main idea for this webinar, to show you and to help you to find the solution and to understand the importance of the money management. Understand this, right? You definitely have to put some effort to find the best practice, the best money management approach or method to manage your money in life and in trading. So what about the definition? Definition for the money management, we have a lot of them, right? But I would consider two the best, two the most understandable. So the first one is the money management is the way of making decision of what percentage of the account or deposit you can use or risk in every trading situation and opportunity. So I think this is clear, and let's move to another one, and after I will explain a bit more. Also, one of the really good explanation and definition for money management is a concept or system for determining or calculating an optimal fixed amount of funds on trading account or percentage of your funds that you will risk each time in opening new position or opening new trade. So what does it mean? That it's the concept that helps you to calculate the amount of the money that you're ready to risk in every new position, which is simple, logical and understandable. After this definition, we have word risk, and I will explain it. What is that? The risk is the possibility of a negative deviation between plan and actual results. What does it mean? For example, you're planning to make money, right? And your plan was like 25 points, but somehow if you didn't get it and you got like minus 25 points, so you lost, and there was a risk. And all the time in every trade there's a risk, and you have to understand it, and considering this risk, you have to find the best position, you have to find the best opportunity and the possibility to enter the position, to open a trade. For example, if you have like five choices, right, you have to find the best one where like the possibility for getting profit, it's much higher, much higher between all of them, and like the possibility to get the risk, to get losses, it's gonna be like really less. So there's like the main idea that you have to consider and understand that first, before going to any position, you have to account and predict what kind of risk it will bring you, and after that find the best position to enter to get more profit. We have two types of risks. First one is individual. What I mean is, for example, you didn't pay for internet, right, and you just entered in the position and you bought some kind of assets, and bam, there's no internet, right, or there's no light, for example, and you didn't have time to put the take profit and stop loss, and maybe even when you were successful and the price went up where you've been predicted, and you didn't get this profit. Why? Because you didn't put the take profit. So, and after that, for example, price went down and you lost, right? So this kind of individual risks. Also, if you in general are just trading, right, and you didn't put take profit and stop loss, it could have the same effects. You didn't put it, and after there was no light, or like you should be doing some other stuff, you were busy and you didn't have time to close the position, and also you could make the money but you got losses. Why? Because you didn't take profit. This is individual risk. Market risks, it's some kind of tornado, accident, explosions and stuff like that, that you cannot really predict and plan. So that's why you have to consider them and use all the instruments. I will tell about these instruments a bit later, to protect yourself. Also, just for your understanding, in other words, individual and market risks you can call like internal and external. Here we have some kind of instrument to protect you from these market risks. It's diversification. So diversification is the use of several different investment instruments to reduce your market risks. For example, you have 4 baskets, right? And somehow in this case you can like imagine 4 baskets. It's like 4 kind of assets that you're trading. So in general you can trade, for example, euro dollar, Great Britain pound, euro dollar and Canadian dollar, right? These kind of pairs and assets are some kind of have big correlation between themselves. And for example, if something happened with dollar, it will affect few of them. So in diversification, you have to choose the assets that have different position and different correlation. For example, if something happened with one asset, it will not affect another one, or like it will affect, but just with small percentage. So diversification, it's using several different investment tools to reduce market risks. In this case, for example, you will protect yourself if something happened with, for example, let's say we will have few assets. First one it's euro dollar, second one it's coffee, and third one it's Japanese index or Japanese stocks, right? So they're kind of different and the correlation between them are really small. So if something happened with one asset, other one will cover these losses ideally, so you are more protected. So really pay attention for that and use it in your life, in your trading, in your money management. So we have 2 money management methods. It's groups of methods. So first one, it's aggressive, as you can see, right? And second one is conservative. And let's speak about them, and let's start from aggressive one. Let's start from aggressive one. Yes. So there's like two types of aggressive methods of money management. It's Martingale, and second one is anti-Martingale. So let's speak about Martingale. How does it work? It's really simple. For example, if you in first trade got some losses, right? You lost, and second trade that you will open should be 2 times bigger, or like volume should be 2 times higher than in previous one. For example, you bought 1 lot, you lost. Next time you buy 2 lots. If you still lost, third time you will buy 4 lots, and you are doing this stuff until you will win. So I mean, it's cool, it's interesting approach, and like the benefit of this approach is that in one trade you can definitely cover all the losses that you had before, but there's like one big minus that statistically it could be 7, 9, 10 whatever losses, or like bad trades in a row. So it will bring you really huge risks, and I'm not sure that after 7 or 9 losses in like trades, you will be ready and you will have enough deposit to buy one more time like next position with like huge lots. For example, on 10 times after like losses, you would need to buy like more than 1,000 lots more than in the previous the first time. So that's why this approach is like really interesting, but it's too risky. Somehow, you know, it could really help you, but I mean, you have to understand the risks. Anti-martingale. How it works: you buy the position, for example, you enter the position and you won. Next position, you should increase the volume of the trade. It could be 1.25, increasing 1.5 or 2 times. And like this time, like all the time, you increasing the volume. But you will increase just in that case when your position are profitable, when you're lucky. So this is really cool strategy if you are lucky and you get in profit, but it's not really useful when your prediction wasn't right, when you get losses. Why? Because when you lost, you need much more profit to cover the losses. For example, if you bought the asset and you lost 20 points, next time you will enter the position with the smaller lot, smaller volume, and in this case you would need more profit, more points to cover the previous position. So that's why it's not really useful. So let's move to conservative methods, and like there are 4 major methods. So first one is no money management. I think somebody knows that. I mean, all of us. Second one is fixed amount method. Third one is optimal percentage of Ralph wins, and fourth one is fixed percentage method. So let's start from the first one, and I think that all of us passed through this method, right? And I remember myself, and I've done it a few times. It was not really funny, but you know, now when I'm you know, trying to see how it was, it's funny because now I understand it, and probably I had to have this experience in the past, so now I understand how it works and what should I do better. So most of us, you know, in the beginning started from this method, when you know, just go all in, all deposit, all volume, maximum volume, and just like, I know, 80, 90, 100 points in different direction, and we're done. We're out of the market and there's no deposit. But you know, it's just like the experience. Another one, it's fixed amount method. How it works: for example, you have, let's say, $20,000, and you plan for yourself like $200 amount that you maximum can lose in one trade. So what do? Based on this $200, you predict and pretend maximum what's going to be stop loss for you, and based on the points for stop loss, you understand what volume you will enter. So you divide it, for example, $200 for the amount or quantity of points, and you understand what is the lot or volume you need to enter the position to lose maximum $200. This method is quite good, but one minus for this one is when you changing your deposit like 2 times or something, you have to review and change this fixed amount, because when you're trading and you have $20,000, $200 for profit and for losses, it's like 1%, but when you have $40,000, it's gonna be like 0.5%. So you need to increase it with deposit and decrease it when your deposit is going down. Third one is optimal percentage of Ralph wins. So how it works, for example, there was four friends, they decided to toss coins and statistically like check what kind of approach is more successful, and they've been tossing like 40 times. First friend were putting 10% of his deposit in each trade. Second one was putting 25% of his deposit in each trade. Third one 40%, and fourth one 51% of his money in each trade for like 40 tosses, right? So statistically, in this case, the second friend who been putting 25% all the time for like each tosses, got 10 times, like make his deposit 10 times bigger and higher that, from the beginning. So it means that, considering this kind of percentage of Ralph wins method, if you will put like 25% of your deposit in each trade, you will in 40 trades you will increase your deposit 10 times. But I don't think so, and you can try. You have time and chance for that. It's your possibility, it's your responsibility, but I don't think that is the best idea, because it's too risky. In this case, if you have three, 4 unsuccessful trades, you're done. So you can try, but this is the method. I'm not using this, but I have to tell you the same. I'm not using aggressive methods, Martingale or anti-Martingale. But I have to tell you, you have to know it, you have to understand it, and maybe sometimes you can use it. Sometimes you can just try it, just at least for fun, or like just to try. Maybe it will work for you. I don't know. You never know until you try. Okay, let's move to the last one, and the last one is the fixed percentage method. I'll tell you this method I'm using right now, and I'm advising to use my clients, my friends, and people that I know that I'm teaching. Right, this method are most popular and successful statistically and worldwide and in general. How it works? For example, you have deposit, let's say $20,000. So you decide for yourself and answer 2 questions. First question is how much money, or like what is the percentage of your deposit that you are ready to lose maximum in each trade. For example, in my case, it depends from 0.5% to 2% in each trade. Depends on the what kind of situation. If it's really good, I enter with the 2% of deposit that I'm ready to risk, which means that at least 2% of my deposit I'm able and I'm planning to make in this trade. So this is the first question that you ask yourself: what is the percentage in each trade that I'm ready to lose? Let's say 1%, just average, right? And the second question that you have to ask yourself, it's like how much in general I'm ready to lose for this deposit, right? After that, I will stop my trading, and I will try to find why I'm not successful. For example, let's say 1% in each trade you're investing, and getting some risk for that 1%, and let's say 20% of the deposit, or like 15, you are ready to lose in general before you stop, right? So it means that statistically, if you're gonna have like 15 not successful trades in a row, you probably will stop trading. But it's like the possibility is really slow and low for that. So you will answer this question and start trading. In this case, you will be more confident and responsible for your trades, and you will account them. So for example, if you have deposit $20,000, 1% is like $200. So this is the maximum that you are ready to risk, with the possibility to make $200 or more, or like $300 profit in this trade. And when you have $40,000, 1% is like $400 for each trade. So this method is simple, it's really reliable and useful, and I like it. So you can use all of these methods, you can try them, but my suggestion, my advice, use this one, because it works for me much better and for my friends. And just having some conclusions, all the time try to evaluate any methods, and the best method that work for you, those one that will bring you more profits. For somebody it could be Martingale, for somebody it's fixed percentage, for somebody fixed amount, I don't know, just you have to decide. But first you have to understand it's gonna bring you more profit, and second, you have to understand and count your risks and be ready for them. And after that, just go for it and make more money. And when you find your method, just use it, keep it, discipline yourself, and be successful in trading and in life. So that's it, and thank you for attention. I'm sure and hope and sure that this webinar was really interesting and useful for you, and you will start to use these methods, at least one or two, the best for you. They will work and you will start to make more money. Also about our company, we have office, as I told before, in Dubai, and our clients, new clients, are more than welcome to come to our office to ask any questions, to see what kind of investment offers do we have, what kind of services, and definitely gonna find something for themselves. And if you're not in Dubai, you can use the chat and ask the same question and get the same answers. So thank you very much. Welcome to our offices, our website. All the best and good luck in trading. Bye.